Chapter 1. Explanation and summary of accounting concepts. As mentioned clearly in the introduction, no new work can be done in accounting before you are assured that you understand the work previously done. So the following concepts should be known to you. Firstly, sole trader. So different forms of business enterprises are distinguished by virtue of how the capital was gathered and who is entitled at the end of the financial year to the profits which was made. So on grounds of these two aspects, they can be distinguished between a sole trader, a partnership, and public companies. So sole trader would be done in grade 10. Partnerships would be done in grade 11. And then public companies, that's the big one, left for grade 12. So in grade 10, attention will only be devoted to the bookkeeping of a sole trader. So in other words, this is businesses where only one owner contributes all the capital and is also entitled to all of the profits. Secondly, the business entity principle. So the entity principle determines that the owner and the business are two separate persons or entities with a separate set of financial records, assets and liabilities. So the business owns therefore separate assets and the owner owns only that share contributed as capital in the interest of the assets. If there are other liabilities, they also have interest in the assets of the business. So in other words, you would have two separate bookkeeping systems, one for the owner's personal affairs and one for the business's affair. And the two only links together. So it's almost like a bridge from the one book to the other book, only by means of the capital contribution. That's the only thing that will really appear in both. Capital contribution into the business from the owner. So the owner of a sole trader can be kept legally liable for all the incurred expenses in the name of the business. If a sole trader becomes insolvent, the owner is liable for the outstanding debt and that cannot be repaid. So if all the debts cannot be repaid out of the assets sale of the business, then the personal assets of the owner can be sold to discharge the debt. So this is called unlimited liability. It's a very unsafe form of business because if the business closes down, the owner would not only lose the business in totality, it would also lose some of its personal assets. So for instance, if there's still debt to be repaid, then they can come to the owner's personal car, personal house, get the money from there to pay for the liabilities. So it's a risky business to start a sole trading business. Thirdly, owner's equity. It's important that you understand owner's equity fully. As mentioned above, the owner has interests in the assets of the business. So this interest is determined by the amount of capital contributed by the owner. So if the business has no debt, the owner will possess 100% interest in the assets of the business. If there are liabilities, however, the owner will own the interest in the assets which remains after all the liabilities are repaid. This amount should be equal to the initial capital invested by the owner in the business plus all profits. So initial capital plus all profits made, less the part of the profits already taken or withdrawn by the owner. So let's look at a simple explanation for all of this so that it makes sense to you. A simple way to explain the owner's equity is to assume that the business closes its doors today and all the assets are sold. So all the money from the asset sale is thrown onto a heap. From this money, all the liabilities have to be repaid, and this needs to happen first. So we first take from the heap, we take the money needed to repay all the people that we owe money to. Then the money that remains after all liabilities are repaid is the money the owner gets. In other words, it's his interest in the asset. So if we take a logical deduction from all of this, if we draw up an equation, our equation would say owner's equity is then basically all assets minus all liabilities. So I've liquidated, that's the fancy term we use. I liquidate all of my assets. Then the money I get from my assets, I first pay back all of the liabilities, all the people I owe money to, and then whatever is left, that is known as owner's equity. Another way of calculating owner's equity as well is to say owner's equity should then, and doesn't matter which one you use, it should give you the same answer if your bookkeeping is done correctly. Another way of doing it is to say, if I take my capital, so initial investment from the owner, and I add all of my money made in the business, in other words, the profit generated from the business, I add that to the capital. And I subtract drawings. Remember drawings from last year? Drawings, that is the money the owner took for himself. So if I take my capital, I add my extra profits made, and I subtract my drawings. That's then my owner's equity. Maybe something just to clarify quickly. How do I get my net profit? Remember, that's all of your incomes minus all of your expenses in 1 year. So in other words, all my incomes for a year minus all my expenses for that year, that results in net profit. So in other words, all the money invested plus all the money the company or the business is making minus what was already taken by the owner. That gives you owner's equity. The next that we will pay attention to is our accounting equation. Our accounting equation you should know off by heart. We're going to use it a lot, and that's what the whole accounting system was built upon. So it's assets equals owner's equity plus liabilities. And I'm making it specific colors. Assets, yellow, because it's that part of the business that makes the owner just smile and glow, and it's sunshine to the business. Owner's equity shows the growth, so I make that green. It's the owner's growth in the business. And red light, that's my liabilities, is red. It shows danger. Okay, so let's look at assets first. So assets, first of all, you should know is what belongs to the business. And that thing that belongs to the business is going to use that daily to generate more income. So it's going to use the shop that it's in, it's going to use the vehicle it's in, it's going to use the stock that it's selling. All of those things are going to be used for the purpose of bringing in income, in the end making more profits. So assets. Assets of a business are the possessions in which the owner and other institutions outside of the business, like banks who allowed the loans to the business and creditors from whom goods were bought on credit, have an interest in. Banks will only allow loans to a business if the bank is sure they will get their money back, or if they cannot repay, that there is enough assets available to be sold so that the bank can be sure they will get the money back. Same, creditors would only sell on credit to a business if the business is liquid. In other words, the business can repay its debts with proceeds that the business generates monthly. But if the business does not earn enough, the business owns enough assets that can be sold to repay the debts. So they always make sure if they allow debt, that there's assets to cover the debt. Okay, does that make sense? So for credit lenders, it's always important to be aware of the amount of debt a business already has. In other words, who has already interest in the assets of the business before allowing further debts. So from the above, the following logical deduction can be made. Assets equals owner's equity plus liabilities. So there's three main types of assets. Two that you are already acquainted 2. And the third one we will only learn this year. So 1.4.1, this one you know, non-current assets, also called fixed assets. Now non-current means that is your long-term assets. The word current means now, so non-current means not now. Okay, so it's long-term. So fixed assets are bought to be used over a long period in a business and in the everyday operations of the business. We only distinguish between 3 non-current assets, namely land and buildings, vehicles, and equipment. These assets are used so that the business can make a profit. That's important. Naturally, the value of these assets will not remain the same over the years. This year you can experience that the value of a vehicle and equipment decreased every year, and that it cannot be sold for the same price that it was bought for. You know this already. If your dad buys a car today, a year from now that car would have lost value. So we're going to look at the losing of value a little bit later, but now you can just understand fixed assets loses value, especially your vehicles and equipment. But luckily land and buildings normally picks up value. So we call that accumulates value. It increases in value. So the next asset is called the financial assets. And this is a new one that you will only learn this year. So financial assets, this is a new concept which will be introduced to you during this year. A financial asset arises when a business transfers money not needed for a period of time from its current bank account, where absolute minimum interest is earned, to a fixed deposit account where it's invested at a higher interest rate for a fixed period at the bank. So your fixed deposit is just a better account to keep money in there that does not need to be used right now. So it can just lie there and accumulate interest. So we call that passive income for the business. Then the third set is my current assets. So current means now. It's my now assets. So now means it's my short term or my current assets. Assets whose value varies monthly and can relatively easily be transformed into cash in order to meet monthly obligations, and therefore fairly liquid in nature, are called current assets. The 6 current assets which usually are placed in liquidity order are, so liquidity means that how easy or how difficult is it for me to change this asset into actual cash. So the easiest one to change into actual cash, easiest and quickest, is my cash flow, starting from the bottom going up. So it's in descending order for liquidity purposes. So cash flow, that's your small change needed to start and end every day in the cash register. Okay, so that is the money that I put into my cash register. So it's already money, it's already in the shop, it's there already, it's the most liquid form of cash I've got. Second to that is my petty cash. Now petty cash is also, it's already in the shop, that's the cash I keep for all the small cash payments that I need to make. So someone's in charge of the petty cash and they can exchange the money or take the money out of the petty cash box at any time needed. So cash flow, petty cash, it's my easiest forms of cash because it's already in the shop, it's already there, it's already cash, it's easy. Thirdly, you get your bank. Now bank is already cash, but it's at the bank. So therefore it's a little bit more tricky to get it to the shop. I need to first go to the bank, withdraw the money, and then bring it back to the shop. So it's the third in line to being changed into liquidity purposes. So it's money in my current bank account or check account for day-to-day payment transactions. Thirdly is your savings. It's also already money, it's also already cash, but sometimes there's a clause to the savings account which says that you can only withdraw the money in 10 days time or 30 days time or so. So it's a little bit more difficult to get the money out of the account. It's not as readily available as cash float, for instance. So savings account, that is money in a separate bank account with a view of higher interest rates but no fixed investment period. So it's also anytime available. Then we get to the two most difficult current assets to convert back into cash. Debtors control, second most difficult. Debtors control, that is the money that is owed to the business by the debtors. So it's a summary of all transactions with debtors. So in other words, it's money that belongs to the business, but it's still in the hands of the debtors. So for us to change that money into cash, we first need to get the debtors to give the money to us. But luckily, it already belongs to the business, so it shouldn't be that difficult to get the money from the debtors. Then lastly, the most difficult to convert back into cash, that's my trading stock. So think about it. Trading stock, most difficult to convert to cash because I have the stock in the shop, but I first need to get people to come into the shop. They would look around the shop. Then they would show interest in buying the trading stock. Then only once it's sold, I can say that it's now cash that I've got in my hand. So I first need to find a customer willing to buy from me. Then only I can change it into cash. So it's the reselling of goods at a profit. And that's your last current asset. Our next very important set is liabilities. That's your red zone. Red zone because that's your warning light shining to say, watch out, don't get this area to be too high. Liabilities are concerns outside the business to whom money is owed, and thus having a share in the assets of the business. If a business closes its doors and sell all of its assets, all the liabilities would have to be repaid firstly, whereupon the owner will be entitled to the remaining money. This can perhaps cause that the following deductions is not so easy understandable. So if I change my accounting equation, it now looks as follows. If I want to work out liabilities, I would take my assets, all of my assets, minus owner's equity, and therefore that would result in liabilities. There are certain accounting principles and procedures, if applied generally, assure that it shall be true. Now these principles will be attended to in detail during the year, and you can look forward to see how the pieces of this jigsaw puzzle falls into place. For now, you only need to know the general things about liabilities, and that is that there's two types of liabilities, which you already actually know. Firstly, you get your non-current. So again, current means now, non means not now. So your not now liabilities, or in other words known as your long-term liabilities. These are long-term liabilities, are debts repaid over a period longer than a year. We distinguish only one non-current liability, and that's the form of a loan. Also, you can see a mortgage loan. When you see a mortgage loan, remember mortgage stands for the loan on a house or the loan on a building. So that's a very long term. They actually give us anything from 18 to 25 years to pay back such a loan. So this money is used within the business to make a profit. The bank will, of course, not lend the money free of charge. The cost linked to the lending of money is called interest, and that needs to be paid. This is a new concept to be looked at in more detail at a later stage. So non-current liability, that's a liability where the bank allows you to not pay back all the money immediately, but to take your time, a year or longer to pay back. The second type of liabilities is your current liabilities. Current liabilities, current means now, so that's your short-term liabilities, your now liabilities. These are liabilities repaid over a period shorter than a year, and of which the amount changes continuously are called current liabilities. The two current liabilities we get are called, first of all, your creditors control, and secondly, your bank overdraft. Now, creditors control, that is the people we owe money to for the goods that we bought on credit. So that's our credit suppliers. Bank overdraft, we've spoken about that briefly in grade 9, but bank overdraft is an arrangement that we made with the bank to issue checks for more than the amount of money that was in the current account. More than the money that was in the current account. That's the key. That's the important part here. So the bank determines a limit for the bank overdraft based on the business credit ability. This is the same as a loan, and the bank will also charge interest on the overdraft amount. So that's, in other words, we've spent everything that we had in the bank and then went over and started to spend the bank's money. Okay, so we go into the negative with our bank account, and that negative is called overdraft, bank overdraft. Before we go on with the rest of the terminology, it's important that you just recap quickly what is the accounting equation or the accounting cycle. So the accounting cycle, every day there's transactions happening within a business, and those transactions daily needs to be put onto source documents. We're going to quickly run through the source documents in a bit, what you're supposed to know already. From the source documents, you post the source documents onto your journals. Now, in your journals, that happens daily as well. Then the journals are posted firstly daily to the debtors and creditors ledgers, updating the personal accounts of each debtor and each creditor. And then the total journal gets posted once a month to the general ledger. From the general ledger, we draw up a trial balance, and then from the debtors and creditors ledgers, we draw up a debtors or creditors list. And this happens once a month at the end of the month. After that, once a year, we draw up financial statements. And this is now, you haven't really done financial statements yet, but we are going to do quite a bit in grade 10. So this is an important, very important part of the accounting cycle. The financial statements that we do is an income statement and a balance sheet, and this needs to happen once a year or annually. Then accounting gets really, really interesting when we start to do our analysis and interpretation of financial statements, and this also happens once a year. And then after that, the cycle just continues, then goes on to the next month, starting with source documents, journals, ledgers, trial balance. Source documents, journals, ledgers, trial balance, until the end of the year where we get to financial statements and analysis again. So bear that in mind when we go through the rest of the terminology. So transactions, source documents, and subsidiary journals. The first step in the accounting process is to keep book of all the daily transactions which involves the business. So some transaction can be described as any trade action that involves money. When a transaction incurs, a source document is completed that provides information regarding the transaction. Each transaction is then recorded from the information as it appears on the source document into the specific subsidiary journal. This is also called the book of first entry. So the transactions that you must already know by now from grade 8 and 9 is the following. Firstly, when I receive cash, remember it goes into the CRJ, and the source documents that I get is a duplicate receipt and a cash register roll. Secondly, any payments that is made, that's recorded in the CPJ, and remember the check counterfoil is my source document. Then I can also make small cash payments out of the petty cash. Therefore, I use the petty cash journal, and the source document is the petty cash voucher. Then I get my credit transactions. Now, my credit transactions is I can sell on credit, or I could have bought on credit. So if I sell on credit, it means that the DJ is my journal, and a duplicate sales invoice is my source document. Whenever I buy on credit, I use the CJ, the creditor's journal. And then my source document is not a duplicate, but an original renumbered credit purchase invoice, or just an original credit invoice. Number 6, items which the debtors are unsatisfied with and they return it to us is recorded in the debtors allowances journal. Now, some of you might not have done this in grade 9, so therefore you need to pay close attention to how it's done in grade 10. If you want, you can also go back to the grade 9 videos and just recap it in grade 9, because it's actually part of the grade 9 syllabus. It's a duplicate credit note is my source document. Then I could have also returned things to my creditors if I'm unsatisfied with it. Therefore, it's in the CAJ, Creditors Allowances Journal, and my duplicate debit note is my source document. So from the journals, I post to the ledgers, and I get 3 ledgers. My main ledger is the general ledger, and then I've got 2 subsidiary ledgers, which is the debtors and creditors ledger. So for each debtor and creditor, a personal account is created, what we call a subsidiary ledger. Now, each transaction involving a debtor or creditor must be posted on the same day that it happens to the creditor's or the debtor's personal account, and the balance is immediately updated or adapted. This is done to determine at any given point in time the amount that the debtor owes us, or the amount that we owe to a specific creditor. So in other words, if a debtor comes into the shop any day, any time, we must be able to, on that day, say what is the amount that he owes us. So it can't be done once a month, it has to be done daily as soon as possible after the transaction happened. So each transaction is then posted separately to the personal account of the debtors or creditors. In the general ledger, however, we have a collective account called debtors control or creditors control, and it is composed, which is a summary of all the separate transactions appear during the month of the different personal accounts. So at the end of the month, a list is drawn up of all the outstanding balances of the debtors and creditors, and as it appears in the subsidiary ledgers. And the totals of this debtors list has to correspond with the debtors control account, and the same for the creditors list needs to correspond with the creditors control account. This is actually so important, I'm just going to say it again. The total of the debtors list needs to correspond with the balance of the debtors control, and the total of the creditors list needs to correspond with the creditors control, because remember, debtors list, creditors list is the personal account, so it's the separate accounts of each and every debtor or creditor, whereas debtors control is the collective one that added up all of them together, the grand total. So if I add all the separate ones together, it must give me the total. It can't give you a different total. So the general ledger, this is the main one. This is the one that we will focus on. So this is really so important. I'm going to write the NB. It's so important that you understand the general ledger very well. It is divided into two main sections, namely the balance sheet and the nominal accounts section. So the balance sheet account section consists of all the accounts employed to prepare the balance sheet. Remember, the balance sheet was one of your financial statements prepared at the end of the year. So it has the two direct owner's equity accounts. It consists of all of the asset accounts, and it consists of all of the liability accounts. Then the nominal account section consists of all of the incomes and all of the expense accounts, because that needs to calculate the profit which is found in the income statement. So all incomes, all expenses, that is what makes up the nominal account section. So at the end of the month, all subsidiary journals are posted to the general ledger. It is very important that the double entry principle is always applied when posting to the general ledger. Now, the double entry principle determines that for every debit, there must be a credit made in another account, and that the account must refer to each other. So in the debit account, I will write the name of the credit account. And in the credit account, I will write the name of the debit account, so that I can see the link between the two the whole time. So all ledger accounts must be balanced at the end of the month, and a trial balance is drawn up to control whether the double entry principle was applied correctly. Incomes and expenses. As already mentioned, all incomes and expenditures appear in the nominal accounts section of the general ledger. So an income can be described as money earned by the business from any trading activity or any investment activity. So examples of incomes are sales, rent income, fixed interest on fixed deposits, etc. Expenses can be described as any incurred expense with regard to a trading activity or a financing activity. So it's the cost to having that activity. So in other words, it's like cost of sales or wages or interest on loan. So to work out net profit, it looks as follows. Net profit is all of your incomes minus all of your expenses. Profit and loss. The main reason to start a business is to make a profit. The owner invests capital in the business to make the profit. The capital is used to buy assets to run the business and thus making a profit. So in the case of a sole trader, all the profit belongs to the owner. The owner has the choice to leave the profit, which has been made, in the business and to buy more assets with it. So in other words, to enlarge the business. It remains the money of the owner, and all profits not withdrawn will increase his share in the assets of the business. However, the owner can withdraw the money. It will then decrease his share in the business. So profits is calculated by deducting incurred expenses from the incomes earned. If the expenses are more than the income, then it's a loss, and the owner's share in the investment of the business has decreased. It is the risk taken by the owner when he starts the business. If the business makes a profit, his investment has grown. But in the case of a loss, the value of the investment decreases. So it's a risk for him, and that's the risk of running a business. From the above, the following two logical deductions can be made. Again, owner's equity, as we said previously, is your capital plus profit minus drawings. Or it can also be owner's equity is capital minus a loss minus drawings. Financial statements. At the end of the financial year, so in other words, the end of 12 months, on which an accounting report must be presented, the financial results of the business are given in an easy, readable manner in the form of two financial statements, in other words, an income statement and a balance sheet. The income statement is the incomes and expenditures appears on the income statement, and that is to calculate the net profit. That's the purpose of an income statement, and it's the net profit for that year. So only the nominal accounts appear in the income statement. The balance sheets, on the other hand, the balance sheet provides a clear picture of the financial situation, or we can also say the financial position of a business on the last day of the financial year. So income statement is for the year, for a period of 12 months, whereas the balance sheet shows a clear picture on that specific day, in the form of showing all the assets, which is equal to owner's equity plus liabilities. One can thus see exactly what the interest of the owner and that of the outsiders are in the assets of the business. Accounting cycle, as we've mentioned previously, just a quick rundown. It is always important to distinguish between which accounting procedure happens daily, monthly, or once a year annually. So again, just the daily procedures, those are your transactions, your source documents are completed, your journals are completed, as well as the debtors and creditors ledger. Monthly, I close off my journals to my general ledger and I draw up a trial balance. I also prepare the debtors and creditors lists. Then our annual procedure is to prepare the income statement, the balance sheet, and then to analyze the financial statements. Let's look at a summary. It's very important that you classify your accounts correctly. So please print this out. Make it an A3, make it big, put it up on your wall so that you can always be reminded of which account is which. So your assets, those are your non-current assets, your financial assets, or your current assets. Your non-current assets, those are land and buildings, vehicle and equipment. Later on, we're also going to learn about accumulated depreciations on vehicles or on equipment. Financial assets, those are your fixed deposits. We're going to learn about them in Module 2. Your current assets, as described, there's 6 of them. You get your trading stock, debtors control, savings account, bank, petty cash, cash float. Later on, we will also learn about provision for bad debts, also learn about consumable stores on hand, accrued income, and prepaid expenses. Then in terms of my owner's equity, 3 types. We get the direct accounts of the owner, which is just capital and drawings. Then we get the indirect, which is the incomes and the expenses, which later on is going to calculate your net profit. So the ones that you know already, your incomes, is your current income, sales and rent income. Later on, we're also going to learn about discount received, interest on current account, interest on savings account, interest on fixed deposit, interest on overdue accounts of debtors, and possibly a provision for bad debts adjustment. Expenses, there's always plenty of expenses. Cost of sales, debtors allowances, telephone, stationery, wages, water and electricity, rent expense, salaries, insurance, repairs, fuel, advertising, donations, postage, packaging materials, all of those you know already, or you should know already. Then we're going to learn a few extras, going to learn about bank charges, discount allowed, interest on overdraft, interest on loan, interest on overdue creditors, pension fund contribution, medical fund contribution, UIF contribution, bad debts, depreciation, trading stock deficit, or provision for bad debts adjustment. So as I've said, print it out, put it up on your wall. You're going to really use it a lot during this year. Then lastly is your liabilities. Again, you get 2 types. Remember, you get your non-current and your current. Non-current loan, you can add there for yourself. It can also be called a mortgage loan. Then your current liabilities, creditors control and bank overdraft, you should know by now. And then we will also learn about creditors for wages, creditors for salaries, pension fund, medical fund, SARS, pay as you earn, UIF, accrued expenses and income received in advance. Let's look at a few example or exercises to just test whether you've paid close attention to what you've done in grade 8 and 9 in terms of terminology learned.